What's up, guys? And today this is going to be an introduction to dividends and what constitutes dividend investing. So you might be wondering, what are dividends in the first place? Well, dividends are a form of payment that are made to shareholders of a particular stock. So for example, let's say you own 2 shares in Apple. That means that you're entitled to any dividends that Apple pays. Now, dividends are only distributed if a company is profitable on an earnings or free cash flow basis. So essentially, the company needs to actually have cash to be able to give dividends to shareholders. And essentially, if a company doesn't reinvest the cash that they've got back into the business, usually they'll start to return that type of money to their shareholders, and that is done through dividend payments. So there are different ways companies can use their extra cash that they have on hand, either through dividend payments, share buybacks, or also just reinvesting it into the business, like R&D or acquisitions. Now, cash dividends are the most common type of dividend that are issued. This is where shareholders receive cash payments. The other type is stock dividends. This is where shareholders receive additional shares of a company's stock, but not many companies do this. So if we delve deeper into Apple, for example, this is a screenshot of Apple's dividend history as of 2023. So the way it works is essentially a company will first declare a dividend to be paid on a particular date. And usually what will happen is they'll provide the ex-dividend date and the payment date. So the ex-dividend date represents the date in which a person needs to be a shareholder in a company to be eligible for the dividend on the payment date. So essentially what this means is, if you don't own stock before the ex-dividend date, you won't be entitled to the upcoming dividend. So you need to make sure that you buy stock before the ex-dividend date if you want the dividend payment for the pay date. And then the record date is on the company side. So basically this is where the company formally assesses the eligible shareholders for the upcoming dividend. So when the pay date arrives, the shareholder will receive the dividend, of course, and it will be according to the amount of shares that they own. So the more shares you have in a company, the higher the dividends you'll get. So if we want to calculate this, let's say you have 100 shares in Apple, your dividend payment for the most recent quarter, which let's say is May the 10th to May 16th, obviously. So, you need to buy before May 10th. And then the payment that you'll get on May 16th will be 100 shares times the cash amount of 0.25. So that will amount to $25. Now, of course, when you get dividends, usually it's subject to some sort of taxing. So, obviously in the UK, you're taxed on a lot of things. For dividends, there is a 15% withholding tax that is applied to all US stocks. So to calculate the tax that you have to pay on the dividend, you'll do $25, which is 100 shares times 0.25 in the previous example. And then you'll times it by 0.85, which basically deducts 15%, because this is basically 85% in decimal form, but you're taking out obviously 0.15 as a decimal, which is 15%, and then you'll end up with $21.25. And then of course, if you're a UK citizen, this will be in pounds, so then you have to convert it, the US dollars back into pounds, and then as you can see, it will probably amount to like 16 to 19 pounds, because historically the pound is stronger than the US dollar. So here's some more statistics about dividends that are quite important to know. So the dividend yield is the percentage of which the dividend is paid according to the stock price. So essentially, if you're getting 0.25 dollars every quarter for Apple, that will represent roughly an annual dividend of $1. And then Apple stock price, I believe, is over $100. I'm not sure exactly what it is, but essentially the dividend yield is quite low. Like, less than 1% of Apple's stock price is paid back in dividends to shareholders. The payout frequency represents how often the company pays dividends. So Apple pay quarterly, but it can also be, companies can also pay monthly, semi-annually, or annually. Some companies don't have any sort of payout frequency at all. Sometimes they just pay irregularly. And then companies may also pay special dividends if they've got extra cash in hand. And then payout ratio is the percentage of the company's earnings paid as dividends. So essentially, this is Apple's 15% of Apple's earnings are paid back to shareholders through dividends. Now, you want to pay attention to companies' payout ratio, because if it's too high, it could suggest that, the dividend is not sustainable. So usually like 40% is reasonable or lower. But again, it is sector specific or industry specific. So keep that in mind. Companies in real estate, for example, could have a higher payout ratio, because I believe it is required for them to pay 90% of their earnings back to shareholders, which might be covered later on. So dividend growth is essentially another aspect of dividend investing that's very important to look at. So as you can see, Apple's dividends in the 10-year period have increased over time, which shows that as long as you own shares in Apple, you're going to get more money per share through dividends as long as you hold them in a 10-year time span. So it shows the compounding effect of your dividends over time and how you earn more money. However, you'll start to notice when companies start to first pay dividends, usually they'll have high growth rates, but when they become more mature, it might decrease. So as you can see, from what looks to be 2013 to 2019, they had a dividend growth rate that was over 10% for the most part. But now, their dividend growth rate is comfortably below 10% since the pandemic. So, you might also want to look at companies that have slowing dividend growth, and you might want to start to invest in other companies that have more dividend growth potential in terms of higher percentages. So you might be wondering, okay, what causes dividend growth in the first place? So usually when a company's free cash flow increases over the years, that allows companies to increase their dividend per share. So this is Apple's income statement, and we can see because they have more free cash flow per share, they can start to increase their dividend per share. Now, as you can see, their free cash flow per share seems to increase at a faster rate than their dividend per share. And again, that's because Apple's not gonna spend all their money on dividends, their free cash. Usually they'll spend on buybacks as well, and also reinvesting back into the company. But in general, it's good that if a company has high free cash flow, because it indicates that the company is financially healthy. And as I said before, they can sanction share buyback programs, which is another method of enhancing shareholder value. Also, they can use their free cash to pay off debt as well. So you really want to look for companies with sustainable dividend growth, as it will allow you to earn more money as a long-term investor without having to invest further funds. So moreover, on the dividend growth rates, it's good to check what a company's compound annual growth rate for the dividends are, usually on a 5 to 10 year basis, and hopefully it's over 10%. When it's over 10%, that shows that the dividend growth is quite high. And these are just some examples of companies that have high dividend growth rates. So Microsoft, for example, KLA, Nexstar, Lam Research, Broadcom, and Capital Southwest. So some companies and brokers offer automated ways for investors to reinvest their dividend into more shares of their stocks. This is called DRIPS, which is a dividend reinvestment program. So that's a way to automatically invest your dividends back into more shares of the stock. Now, companies usually don't decrease or eliminate their dividends unless they are in financial trouble. So when dividend cuts are announced by a company, usually it causes a big decline in stock price because, shareholders start to become unhappy if their dividends, are going to decrease. This really does affect, massive shareholders, shareholders that own like thousands of a stock, usually will be quite turned off by big dividend decreases. And that's why sustainable dividend growth becomes all the more important once you have more funds to invest. So the total amount of money that a company pays in cash dividends is usually reported on the cash flow statement. So you can see here, this is where it is, and usually a company will outline its dividend strategy with a dividend policy, which can be found on a company's annual report in the US, which is known as a 10K. So this is Apple's cash flow statement, and as you can see, because their dividend has increased over the years, they'll have more negative figures when it comes to dividends paid because they're increasing their dividend payout. So roughly this will show that, as of 2023, Apple has spent 15 billion paying dividends to shareholders. So paying dividends is usually done by more mature and well-established companies that have had a long-term profitable history, and they don't need to invest, all of their earnings in growth anymore. They're not in the early stage of growth. Usually the terminal stage of growth companies will pay higher dividends. So usually stocks and industries as well that are mature and have limited growth will pay higher dividends as well. So utility stocks, energy stocks, banks, material stocks, real estate stocks, and retail stocks. Industries that don't really have high growth for most companies will usually pay higher dividends. So preferred dividends is another type of dividend policy that is done as well. People can buy preferred stock, and this means that they'll get fixed dividend payments that are different to common stockholders. And these are basically a benefit to owners of preferred stock, essentially. So most people won't be subject to this. So another thing as well is stocks that are on the S&P 500 that have raised their dividend payout every year for 25 years are usually considered dividend aristocrats. And they've got like a special list of companies that are included on that list. I believe Pepsi, Coca-Cola, McDonald's are among those companies. I think ExxonMobil as well. And stocks that do this over 50 years are called dividend kings. So, obviously there are not many dividend kings out there. I think there are only 20 to 30, if I'm not mistaken. And there you go.